For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions because a smart non-billionaire like you is who succeeds in the market when you make informed decisions. Welcome to the Wall Street Exclusive Daily Show. A happy Purim to you and your loved ones. I have 4 pieces of information for you today to help you succeed in the market. The first is a low-risk, high-reward opportunity in the broader markets due to negative real interest rates. 3 of the things we talk about today are about negative real interest rates, a big upside opportunity because of negative real interest rates. Number 2, an opportunity to sell stock insurance to the fearful. Haven't you always wanted to sell insurance anyway? And again, that's negative real interest rates there. Looks like it's giving us an opportunity to do that. Number 3, we'll look at the cybersecurity stocks. We'll break down the big 4 that have been making news. And number 4 is gold. We actually think gold is going to do well from here, especially if you try the strategy we recommend. Okay, let's get to it. Number 1, there's a big low-risk, high-reward opportunity in the broader markets right now due to negative real interest rates. Okay, 3 points I want to make on this first main topic. Okay, the first point is that unattractive negative real interest rates in the bond market are here to stay for the foreseeable future. That's the first. Number 2 is the persistence of negative real interest rates that are here to stay for the foreseeable future will continue to support the stock market. We'll talk about why. And then the third thing is that because of that, there looks like a low-risk, high-reward opportunity for stock market bulls. Okay. The first point there, unattractive negative real interest rates in the bond market are here to stay. Negative interest rates around the central banks around the world are creating negative real interest rates. People want safety. They want to be savers. They want to sit in bonds or something safe. The problem is the world economy is facing secular stagnation and does not have some of the tailwinds of the past, like an ever-increasing labor force. Against that backdrop, central banks have eased. What does that mean? What they're trying to do is force people out of these safe assets, out of safe treasury bonds, and by forcing them out of that, they're trying to make those assets unattractive. And they're doing that, they're trying to make those assets unattractive by buying them up. For example, the U.S. Treasury sells bonds at auction, and then the Federal Reserve will go in and bid them up. So let's say the U.S. Treasury auctions a bond with a $100 face value and a 3% coupon. That means that bond gives you $3 a year. Okay, and you go to the auction, you're like, I'll pay $100 for that, and you want to buy that, right? But the Federal Reserve is there, and they say, we'll pay $200 for that. And it's like, crud, now the going rate for that bond is $200. So if I want to buy that, it's not, that $3 is now yielding me 1.5%. Well, what if interest rate, or what if inflation is at 2%? Then behold, negative real interest rates. You're making 1.5% a year, but inflation is taking away 2% a year, so you're losing 0.5% of purchasing power every year. Negative real interest rates. So the central banks don't want people sitting in these safe assets. They want to stimulate the economy by getting people to spend or invest in stocks, which if you invest in stocks, companies eventually use that to raise money in different ways. Issue shares, IPO, issue shares in secondary market. Okay, so these central banks are trying to get people to spend and invest. That's the point of negative real interest rates. It's the point of quantitative easing. Negative real interest rates seem to be a feature of secular stagnation. This is what secular stagnation predicts: a lack of demand in the economy, not enough spending, not enough investing. And there's no end to secular stagnation in sight, maybe for a generation, maybe even more. Okay, so unattractive negative real interest rates in the bond market are here to stay. That's the first point. Okay, the second point is the strength of the bond market will continue to support the stock market. So why would people sit in these negative rates and lose money, sit in these bonds that have negative real interest rates and lose money? Well, strong hands own bonds. Institutions like pensions and insurance companies, and even the extremely wealthy, have no alternative or are required by law to have bonds, or are highly incentivized to take the least amount of risk, even if it means a small loss with negative real rates. Bond markets are unattractive, but they're not going to sell off because of who owns those bonds. Pensions, insurance companies, the extremely wealthy. They're not going to sell out of those bonds. And that means that rates will not rise for a long time, maybe a generation, a long time. So the stock market may be a little richly valued right now compared to itself historically, but compared to the alternative, bonds, the stock market has never looked so attractive. 10-year treasuries pay about 2% right now. In 2004 and 2005 and 2006, 2007, while the market was shooting up, the market was on a tear, the 10-year treasuries were paying about 4.5%, more than double what they're paying now. So you could get a nice, safe return in treasuries, and the stock market stormed ahead anyway. In the late 90s, the 10-year treasury paid almost triple what it pays right now. And again, the stock market soared anyway. You could get a safe and decent return. People went to stocks anyway. Rates have only been this low once before. They actually have never been this, how they've been in the last year. They actually did not go that low. The only time they've ever been close to this is in the Depression, and they didn't stay there very long. So with secular stagnation, very low rates to stimulate spending and invest look like the new normal. Very low rates look like the new normal. And so you've heard of like flight to safety. It means people buy US Treasuries for security. But the Fed has officially removed the safety. It's a flight to a guaranteed loss. And so, so what we could have here is, or what we do have already happening, I think, is the flight to the only reasonable return, the stock market. And it looks like it's only just begun. The price to earnings multiples of the average stock have gone from like 15-ish to 19-ish. So your average return went from about 6.7% to about 5.3%, 1 over 15 or 1 over 19. But that drop in returns for stocks pales in comparison to the drop in returns for bonds into negative real territory. The multiple expansion in the stock market has been steady and over a couple of years, and it looks like it will, it looks like it will continue to be steady. It looks like negative real interest rates will persist, and that unattractiveness in the bond market will continue to put upward pressure on the stock market. Average price to earnings ratios for the average price to earnings ratio multiples for the average stock should go into the 20s and stay there, maybe forever, maybe for a long time. The stock market has been going gangbusters for 5 years, but how it has performed relative to its own history will not determine where the stock market goes from here. The attractiveness of the alternative to the stock market will determine where the stock market goes here. And like we're saying, central banks of the United States and Europe and Japan, etc., will continue to punish savers to try to stimulate the economy. So negative interest rates are here to stay, and that is great news for the stock market, the only place giving you a reasonable return on your money. So the S&P 500 is at 210 now. It's up 2.28% so far this year. By December of 2017, if it keeps up at that pace, it will be at 308. Is that like ridiculous? Is that too much? Well, it's less than 50% in about a little less than 3 years. That's nothing new really or exceptional. So if the S&P 500 keeps up its rate of return that it's having this year so far, it'll hit 308 by December of 2017. That return could be conservative considering the persistent, very low interest rates in the bond market. The Fed is getting its way. Don't fight the Fed. Okay, so equities as an asset class are going to get more capital allocated to them because of the Federal Reserve. Thank you, Janet Yellen. You deserve a good thank you. So how to play it? Should I go on margin, borrow a lot of money and pay interest on it and then invest it and just hope everything works out? I bet actually that probably would work, but don't do that. Let's look at the options market instead. And then probably the best call option to buy there might be like the 280 strike or the 275 strike. But when you go out that far, 3 years, even on something extremely liquid like the S&P 500, the options aren't very liquid. So look at the strike of $250. That one is trading a lot. It traded today for $7.37. Okay, and then if the S&P 500, if we're right and the S&P 500 goes to 308, you get a $58 for your 737, and so you've more than octupled your money. So if you're buying this, that this bond market is going to continuing to support the stock market, and the stock market's got a long way to go to catch up. then 308 could even be low. Well, there's an octuple for you in less than 3 years, getting that 250 strike. That by the December 2017 250 strike call option on the SPY. You could look at that two ways. You could put all your money on that, which is a bad idea, and then get 8 times your money. Hey, that's pretty great. Or you could keep more than 90% of your money in whatever else, cash or something else, the VO, and then put just a little bit more than 7% of your money into something that could give you more than a 50% return. If it goes to 308, then you get 8 times on that 7%. So you've risked less than 10% and gotten more than a 50% return on your whole portfolio. Something to consider. In the next segment, we'll talk about how to finance that 737, and so the good ways to do that there as well. One other question: if astute viewers will say, Joe, you love the VO. How come you're talking about the SPY? And that's because the SPY is way bigger and more liquid, and its options go out way farther. If the VO had options like the SPY does, I would say go for the VO. If you can do it with the VO, go ahead, but look at how many options traded. It's like 5 or 10 or something like that. Okay, I hope you found that helpful. For the Wall Street Exclusive, I'm Joe Springer, helping you, smart person, make informed decisions, because someone like you is who succeeds in the market when you make informed decisions. Coming up next, we're going to show you how to finance that, buying that call option. And after that, we'll look at the cybersecurity stocks, and then we'll go to gold.